In 1993, the IRS buried a provision inside a 900-page tax bill that could legally erase every dollar of capital gains on certain investments, and has never once required your accountant to tell you it exists. Millions of Americans have paid capital gains taxes they never legally owed. By the end of this, you will understand exactly who decided you weren't supposed to find it. Section 1202 was signed into law on August 10, 1993. Buried inside the Revenue Reconciliation Act, a document almost no one read, it offered something almost no tax provision ever offers: a complete shield from federal capital gains tax on qualifying small business investments. The rule was straightforward: invest in a qualifying company, hold the stock for 5 years, and when you sell, pay nothing, not a reduced rate, not a deduction, nothing. At the time, the Treasury estimated a few thousand investors would ever use it. The paperwork was obscure, the eligibility rules were narrow, most accountants had never heard of it, and that was exactly how it stayed. Here is what changed and when. In 2010, Congress quietly expanded Section 1202 to allow a 100% exclusion, not the original 50%, not the 2009 version at 75%. 100% of federal capital gains, sheltered, eliminated, gone. You could sell a stake in a qualifying startup, walk away with $10 million in profit, and owe the federal government exactly zero. This is not a loophole. It is not a gray area. It is written directly into the Internal Revenue Code, Section 1202, subsection A.4. The IRS does not dispute it. Tax courts have upheld it. Congress has renewed it repeatedly. And yet, researchers at the National Bureau of Economic Research found that fewer than 1 in 12 eligible investors had ever claimed it. The question no official agency has ever answered is simple: why didn't anyone tell them? The official answer from the IRS is that Section 1202 is publicly available. It is in the code. Any taxpayer can read it. Any professional can look it up, which is technically true. The same way the terms buried on page 47 of a bank disclosure are technically available. The same way the fee schedule no one reads is technically disclosed. But here is where that explanation falls apart. The IRS has never required any tax professional to proactively disclose available exclusions to clients. A CPA can prepare your return, see that you sold qualifying stock, calculate a 6-figure tax liability, and file that return without ever mentioning Section 1202, without breaking a single rule. That is not an accident in the tax code. That is a design choice. Now watch what happens next. In 2021, the Biden administration proposed stripping Section 1202 benefits from investors earning over $400,000. The stated reason was fairness. Wealthy investors shouldn't receive a windfall. But here is the thing nobody talked about. The investors most likely to know about Section 1202 and to have structured their holdings to qualify for it were not ordinary founders just getting started. They were venture capital partners, angels, institutional fund managers, the people whose accountants specialize in nothing but this. The proposal would have closed the exclusion for high earners, the very people already using it, while the millions of qualifying investors who never knew it existed would have remained invisible in the data. The bill did not pass, but it exposed something. A 2022 analysis estimated that between 1993 and 2020, approximately $275 billion in eligible gains went unclaimed under Section 1202. Not because investors were ineligible, because they didn't know to claim it. $275 billion. And here is what makes it impossible. Every single one of those taxpayers had a professional prepare their return. Someone saw those gains. Someone filed the form. Someone collected a fee for the service. And no one said a word. Think about what that means. The people who did know about Section 1202 built their entire investment structures around it. Venture capital term sheets in Silicon Valley routinely specify QSBS eligibility, qualified small business stock, the formal name for this exact provision, because the insiders treat it as a baseline tool. There is an entire industry built around it. Law firms, specialized tax advisors, software for tracking eligibility windows, an ecosystem serving a benefit that most of the people legally entitled to it have never heard of. The IRS collected taxes it was not legally owed from people who did not know they could refuse to pay. And the accounting profession, legally trusted to act in your interest, was never required to stop it. Who benefits from that arrangement? Not the founders, not the small investors, not the people the provision was written to help. Section 1202 is still in the code right now. If you have ever invested in a startup, sold equity, or are planning to, the exclusion may still apply to you. But here is what no one has ever explained. If this provision was designed to encourage small business investment in America, why was the one thing they never funded the effort to tell anyone it existed?